Hello everyone and welcome to this week's FX webinar. My name is Craig Erlam, Senior Market Analyst at OANDA. For those of you who have not joined us before, welcome. I hope you find this useful. In these webinars, we like to take a look at the week's key events to come, give some kind of analysis on what's been happening to the best of my ability in these very volatile times, and look at some charts, give some perspective on what my analysis is of them, and hopefully provide some kind of education for those of you who are new to trading, who are not used to the kind of charting side of things. So hopefully everyone will take away something from these sessions, and if not, then please do provide any feedback. It's always welcome. We're always looking to improve. For those of you who don't know as well, this will be recorded. You'll be able to find it on the OANDA Market Pulse website, which is what we're on now. We're on the economic calendar at the moment, but the OANDA Market Pulse website is where we store all of our content. So you'll find the video here on our YouTube channel and also on Twitter as well. You can follow me on there, Craig_Forex. And just as a little promo, please do check out the OANDA Market Insights podcast. That's recorded every Friday in conjunction with Jazz FM, who we do the business breakfast with every morning. And that's pushed out Friday evening. That just gives a bit of a week in review, 15 minutes or so, just highlighting the key topics that we can have in a little chat between myself, usually Johnny, the presenter over there, and more often than not, we have one of the other analysts join us as well, whether that be Steve in Singapore or Alfonso in Toronto, or more recently Ed, a new analyst that we have over in New York. So please do check that out. And again, feedback always welcome. But that's enough of me pushing our other content. Here is the economic calendar for the week. As you can see, a bit of a quiet start. Again, the political events is the main driver in the markets right now. And we'll come across them as we look at the charts and stick with that format for now. It seems to be working quite well. But as you can see, from a purely economic event standpoint, it's a little bit quiet this week. And even the events which do stand out as being more notable, I don't think are necessarily going to be as significant as they may have been 3 to 6 months ago. The reason for that is because, one, because politics is overshadowing, but two, again, linked to politics, for example, with this inflation report hearing, I think central bankers, particularly in the UK, for example, really want to stay under the radar for a few more months while these negotiations play out. So the inflation report hearing today, I followed the vast majority of this hearing. Obviously, later on in the hearings, they can get quite dull. They're usually quite political, so you don't tend to learn too much in most cases with this. And that was no different today. I think Carney was trying to keep his cards close to his chest, didn't want to commit to anything, didn't want to comment too strongly on anything Brexit related, despite the continuous questions and prompts to do so. The pound was volatile throughout, but compared to what we've seen recently, not horrendously so. I think we saw about 40 to 80 pip range throughout this hearing. Now, normally that is quite a move, but I mean, compared to what we've seen, it is really just a drop in the pond, really. So nothing really came out of that from of any note from my perspective. We also had the RBA minutes overnight. The RBA is one of the least active central banks at the minute. While there has been an improvement in the economic data, the unemployment rate, the GDP figures, this isn't filtering necessarily through into significantly higher wage growth. It's not something that the RBA sees as being as changing the near-term outlook for interest rates. I still think they're looking at 2020 for the next rate move, and they are sticking by the belief that it will be a rate hike rather than a rate cut. But from a purely currency perspective, it doesn't really have too much of an impact because we're talking so long term and because their stance isn't changing despite the improvements that we're seeing in the actual economic data. Moving on through the week, for those of you on the other side of the pond who are fortunate enough to have a bank holiday on Thursday, it is the Thanksgiving Day bank holiday. So the US markets will be closed for the vast majority of the day, and or in some cases the whole day. So we're expecting participation to be very low. We're expecting volumes to be very muted. And this can have two impacts on the markets. One, in terms of pure volumes, it tends to be much lower. The US is, of course, a huge player, particularly during the European transition and later on into the day. The other thing as well is that can actually stoke volatility. Low volumes can often stoke quite significant bouts of volatility. Not always, but sometimes, but it's something to be aware of. So that will be Thursday. I expect Friday to be very quiet as well on the back of this. If I'm in the US and I've got a bank holiday on a Thursday, then I'm taking off the Friday and turn it into a long weekend. And I think a lot of people take the same approach here. So I think Thursday, Friday, the end of the week is going to be very quiet, even if there is a lot more data on Friday. Wednesday, we've got Theresa May meeting Jean-Claude Juncker, trying to push ahead with some of the issues with the Brexit deal, the draft Brexit deal that's been reached. There's issues on the UK side, although I think many of these are unresolvable with regards to the backstop. I don't see the EU backing down on this, but there is issues on their side as well. France has raised some issues. Spain has sought amendments for with regards to Gibraltar, for example. So there is things to be ironed out, but hope this is a meeting aiming to try and move this forward. Apart from that, we've got data like the jobless claims, durable goods orders, which is always an underrated piece of data in my view. And then heading into the end of the week, again, central bank speeches throughout the week. We get the ECB minutes on Thursday, but given how quiet they've been, how much they've laid out the groundwork for the next 12 months, I don't really see this being a major event. I think they're going to come out. There's not going to be much change in them. There won't be much movement, and we'll just move quickly on. But again, we do have plenty of speeches which people should keep an eye on throughout the week, becoming more and more prevalent. Central bankers really finding their voice in recent years. And on Friday, like I say, I think it's going to be a quiet day, even if the US is back, but I don't expect them to be back in bulk. So while we do have plenty of data, Canadian retail sales and inflation, US services, composite PMI, and similar in the morning from Germany and the Eurozone and France as well. I think we may see a little bit of volatility around these numbers in the morning, but broadly speaking, I think it could be a quiet end to the week. I think really we are looking at politics, as I've said earlier, as the main driver here. We'll look at the charts, we'll take a look through them, we'll see what's been happening, and we'll also comment on the political developments that we've had in relation to them. So taking a look at euro dollar, for example, we continue to linger near the lows. We did take out these 113s, which I thought was very interesting, to be quite honest, because we'd held there previously. And it was, a week ago, just over a week ago, when we did break below these levels. We saw some risk aversion earlier on in the week, and that seemed to benefit the dollar. That dropped us below those 113s. We didn't really gather much momentum, though, as you'll see from these indicators below the MACD moving averages and the histogram failing to make new lows here before we did spike higher. So that's a sign of weakness in the trend, potentially. We have recovered a little bit on the back of that. Now, for those of you who've been listening, you'll know for weeks I've been medium-term bearish on the US dollar. That's not to say that we can't have further gains in the near term, because that's obviously possible. But I just think there's a lot priced into the dollar that isn't priced into other things. I think too much of the Italian debt situation is priced into the euro. I think the data has been softer, and I think we will see some improvements. Those two things combined alone, I think, provide potential tailwinds for the euro currency in the medium term. The question is, does the Italian situation, for example, get worse before it gets better? Well, it's resubmitted its budget. It's not changed anything. It's committed to 1% of asset sales. We'll hear from the European Commission shortly with regards to that. The chances are this could turn into a long, drawn-out process where they enter into negotiations and it goes very quiet for a number of months. Maybe they put them into an excessive deficit procedure, and then we hear very little from then on in. Other countries have been placed into that before. The question people are asking is whether there'll be sanctions to follow. I still doubt that will happen. I think the markets are going to have a greater effect on this before they do. Bond markets primarily, cost of borrowing. I think if that rises too much further, I think it will force the Italians' hand before the European Commission has to. So I think there's upside potential for the euro in the medium term. The question is, do we trail too much lower? And the markets would suggest to me that traders are bullish. Despite the selling, this tells me that there's just not much momentum currently. That can change. There's not much momentum currently for a much greater downside view. So you may wonder, well, why have I added the fib level? Well, I've added the fib level just to highlight potential areas of weakness. So the 50 fib stands out for me. It's the previous high, the most recent high. So you take this out, and you've already broke the trend of lower lows and lower highs. It's also an area of previous support between these kind of 115s, 115.50s. We've highlighted these in previous webinars. So a breakthrough there from a psychological perspective, I think, is significant. It coincides with the 55 and 89 moving averages, so that makes it stand out as an area of significance as well. It was also interesting that when we did come back to these 112s, this 112 sits on or around that 61.8 long-term fib from the ultimate low to the most recent ultimate high. So that seems a little bit significant for me. We may even dip below here. You can see that previously we kind of got back to these 111s, 111.50s. If we fall to these levels, breaking the 61.8 fib, I'm not going to panic. I don't think it's necessarily a particularly bearish sign. But if we start to break through here, then that would suggest there's something more significant at play here. I think 110 is then a very feasible level, would suggest there's potentially more weakness in this market than it looks at the moment. Like I say, these things can change. We could quite easily see a break of these 112s with momentum behind the move. We could see it without as well. Again, that would just suggest to me that there's a weaker trend, but the markets evolve as they wish, and we are just basically watchers, and we're trying to anticipate the moves. But this isn't... no one here is Mystic May. We all are just trying to anticipate the same thing. For me, I still, like I say, I'm still bearish on the dollar in the medium term. I still think this has room to run higher into the end of the year, early next year. But I guess we will wait and see. But in terms of levels in the interim, I think 115 is very interesting. I think if we break through there, then 116 becomes very interesting. I know these are obvious round numbers, but they also coincide with technical levels as well. So that would take us through the 61.8 fib. If we go through there, then I'm looking back at these previous high zones. So you're looking at around the kind of 117.50s, 118s for the next notable level. And there you'd have the 200, 233-day simple moving averages as well, just to combine additional resistance. And a breakthrough there, I think, starts to look very, very bullish indeed, if I'm perfectly honest. But I'm getting a little bit ahead of myself there. We may have some more pain before we get there. Now, with cable, there's a lot more going on. Yes, we do have the US trade war with China, which is heating up. The tariffs which were imposed last month on $200 billion worth of Chinese imports at 10% is due to go up to 25% at the turn of the year. That's likely to hurt China more than the US. We have generally seen the US dollar benefit during these trade wars. One, because it's safe haven appeal, I believe. I think when you're looking at a safe haven that yields the return of treasuries, I think it's a considerable it's got considerable safe haven appeal. The other flip side of that as well is, though, that when you're measuring a currency, you're always measuring it against other currencies. So if the US is engaging in trade war with countries which are likely to be worse off as a result of it, then it's naturally going to benefit the US dollar by comparison. Everyone, I think, is worse off in a trade war, but when you're looking to compare the dollar against the yuan, for example, then the yuan you would expect to be worse off. Same applies to the euro, the same applies to the pound and elsewhere, because of the size of the surplus, the deficits that the US runs with these countries. That's one story playing into this. The far more prevalent story, though, quite simple, quite frankly, is Brexit, and that's the cause of all of this incredible volatility that we're seeing here. Now, there's two things which really stand out to me in this chart. One is we've been range bound now really for the second half of the year. We've got the low at around these kind of 127s, give or take. We've got the highs around the 133s, 132s, give or take. What's interesting is, while we've had plenty of volatility as people have got excited about good news, for example, when the deal was announced, or bad news when it looked as though we were going to hit the 48 letters that would create a leadership contest, which could still happen, but the fact that they're falling short makes me think that even if they get the 48 letters, the vote in the Commons will falter. Actually, let me provide a little bit of background on that. So Theresa May has come under considerable scrutiny. She's been heavily criticised by particularly the staunch Brexiteers, of which there are many, particularly in the Conservative Party, which she leads. Now, even Remainers have cast doubt on her deal. The DUP, who are in a confidence and supply arrangement with the government, a kind of a kind of coalition agreement to provide that, because the Conservatives fell short of a majority in the last election. They're in this agreement with the DUP. The DUP are staunch Brexiteers, but at the same time, they are unionists, so they want to remain fully aligned with the UK, and they do not want anything in this deal to jeopardize that alliance. Now, they feel betrayed, I think it's safe to say, by the deal that Theresa May's got, not because under most circumstances they will be unaligned, but because the backstop would mean them forging closer regulatory ties with the EU, or retaining close regulatory ties with the EU rather than the UK. Now, Theresa May has said repeatedly that they will do anything to avoid this being triggered, but the DUP is fully believed that as long as there's a backstop in place, then there is the possibility it could happen. So they are very much against it. You've got the SNP, who want to have closer regulatory alignment with the EU and remain as close to the single market as possible, want the same terms, but obviously that's being rejected. It seems that there's a lot of people who oppose the deal which Theresa May's brought back. So you might question, well, why do people still think that's going to get through? Well, that's quite simple. For one, the Tories, the Conservative Party, need 48 people to hand in letters calling for a vote of no confidence against Theresa May. It seemed at one stage that this was going to be comfortable, and come last Friday when we saw this sell-off, it seemed like it was very feasible. The number of people have been handing them in, and it looked as though by the end of the day, even by 1 p.m, they were saying that this could have, they could have enough letters. While it's now Tuesday and they still don't have enough letters, my thinking is that if they're struggling so much to get the 48 letters needed to trigger the vote, then what chance do they have of getting around another 100 votes in Parliament amongst the Conservative Party in order to actually force Theresa May to step down and find a replacement to lead these negotiations? What form would these negotiations take? So it's my belief still, even in these relatively uncertain times, that we are going to either avoid a leadership contest or it's going to fail in Parliament. And when the vote does eventually then come back to Parliament, that it will pass. And the reason why I think it will pass despite all the criticism is because of the alternative being no deal Brexit. Unless we start to talk about the second referendum seriously, which isn't on the table currently, or an election, which I don't think is ever going to be on the table, then we are going to start, then the deal that's going to be on the table, or the thing the vote that's going to be on the table is going to be Theresa May's deal or no deal. So they can continue to pressure now to try and improve the terms. But the reality is, if this goes to Parliament, I think MPs will back this version of Brexit rather than the other, which people see as being far more catastrophic. So I think that'll be bullish for the pound in the medium long term. I think in the near term, though, we could continue to see this whipsawing. We could continue to see this volatility. But interestingly, we are consolidating. So we failed to reach the previous peaks each time we've gone higher. We've also failed to make new lows each time we've gone lower. So we are gradually consolidating here. This highlights the uncertainty that still exists despite all the volatility. We're consolidating around 130. This 130 is clearly viewed. I think markets are pricing in around a 50-50 chance of this deal actually getting through, or a version of the deal getting through, avoiding no Brexit effectively. So I think people generally see the upside as being roughly equal to the downside. I think they see the prospect of deal, no deal being fairly balanced. And that suggests to me that when we do start to move closer towards the deal, and it looks as though we're either going to get one, and the upside could be quite significant. Remember, we were trading back around 143.75 back in April this year. But then the downside, I think, would be quite considerable as well. And I think that's triggering all this volatility, and why we are now seeing this kind of consolidation despite all the volatility. So I think next few weeks could be so interesting here. But it just means in the meantime, if you're going to trade this, you have to be able to stomach this kind of whipsawing volatile action, because intraday, that's exactly what we're going to get. And it's always going to be prone by leaks, by rumors, by speculation, by random comments from random officials. It was only last Thursday, I think it was. Sorry, the days really do blend in when you're following this Brexit stuff. That we had from the police minister, who suggested that Theresa May was no longer going to hold a press conference after the cabinet meeting. That must have been Wednesday, actually. I think most people at this stage didn't know there was a police minister. I certainly didn't, and I've not met a single person who could tell you who that was. But the pound rallied, the pound fell by around 100 pips on that report. That just gives you some insight into the kind of volatility that we do see in the pound right now. still, like I said, we are gradually seeing some consolidation. That could really trigger some quite a significant move once we do break out of that, but we may have to wait a little bit of a while for that to actually happen. Euro sterling pitting the two against each other. Again, you may be wondering why I've added a fib on here when I've said for such a long time that we are range bound despite the little pop above, pop below here. Well, I've just done it as an area of interest. The 61.8 fib coincides with the rising trend line, which we broke below a while back. It coincides with the most recent high, a brief area of support and resistance all along these. So this strikes me as an interesting level, the kind of 89.25, 89.50 area. If we break through here, then it suggests we're heading back towards the peaks around the kind of 90s. Alternatively, if we rotate lower, then we could be heading gradually back towards lows. But again, you can see the volatility which we're seeing here. I still think this is just whipsaw action. I think it's not the most interesting of charts, and it's not really the best one for me in terms of a Brexit chart either. I think it's range bound, and I think we'll see some benefit to the pound if we do see a deal. What we really need to see is a real break through these 90s or a real break below these 86s for this to become more interesting. Because at the moment, it's not even a nice trading range. We're not always hitting the peaks. We're not always hitting the troughs. We are going further above the peaks, the top line of the channel than we may do in normal situations, and vice versa. So it gives us an idea of where we're at the moment, but it's not, for me, the most interesting of charts. The Aussie dollar, we've touched on the fundamental side of things. Technicals, I think, are just so interesting because we did finally see the break above that channel. And from a technical standpoint, it's really just playing out really nicely. We broke through the channel. We broke through the moving averages. We came towards this peak. We fell just short of the 73s, or we hit the 73s and we rotated low. We found support from the top of the channel, the prior resistance, and the 55-day simple moving average. We rotated higher back towards these peaks. We've run into temporary resistance for now. Interestingly, we are seeing a lack of momentum a bit on the MACD histogram, but I'm not reading too much into this. I still think this is bullish in the near term. I think the next real interesting levels, if we can just squeeze above these kind of 73.50s, then 74.50 through 75 looks really interesting. We've got the 38.2 fib there. We've got the 200-day simple moving average and prior support and resistance. So this could be a nice, interesting level. And then above there, the kind of 76s. And then we start to get a real test of this trend. So I think this entire zone here, 74.50 through 75.50, is extremely interesting. And I do think that there's further to run in this rally. But I guess we will wait and see. Dollar CAD, far less so, if I'm honest. And I know I've been saying this on previous videos. It just doesn't really strike me as being particularly interesting right now. I want to see an interesting breakout. We are trading back around these peaks, around these kind of 132s, 132.50s. If we can break through this high, then potentially we're heading back towards these kind of 133.50 type areas, 133.75, and beyond there, then your eyes are drawn to kind of 135.25s. Again, this gradual climb up, really staying in this rough channel that we've got going on here, which we've traded within since August of last year, but we're not really seeing much upside momentum being gathered here, which makes me question just how strong this rally is. Again, you zoom into the most recent highs, for example, the MACD histogram is really looking a little bit weak. The moving averages are starting to flatten off, and even the stochastic isn't really making new peaks. So this suggests to me that we're looking at a bit of a weak uptrend here. We went through the moving averages, which I had on the chart previously, through the fib levels, which I had on the chart previously, so we got a bit more upward momentum than it looked. I'm wondering whether we're going to see a break of this rising trend line soon, and if we do, then this starts to look weak to the downside. And the levels which really clearly spring to mind here then are these 129s, 130s. We've got the 200 and 233-day simple moving average band there. It's a prior area of support here, and we've also got the bottom of that rough channel, and that's, I stress, very rough channel, but that could give us some form of indication. But the longer this keeps climbing, the longer it is that I'm just not particularly interested. I really want to see a break lower, if I'm perfectly honest, in this chart. Sterling CAD's just chaos. Plenty of volatility, plenty of whipsawing, not much directional insight. Again, we are gradually consolidating here. But as you can see here, we hit these peaks around the kind of 172.70s, and we keep coming lower. Effectively, we do have a double top here, so there's no reason why there is potential for this to move back towards the downside here. The double top spanning 169.50 through 172.50 roughly. So that gives us a possible price projection of around 300 pips, which would take us to 66.50 potentially, stressing that again, back towards these previous lows. So there is potential for some more downside. We have found resistance from the previous peak, which is quite interesting in the interim, but there's no reason why we couldn't, say, for example, come back a little bit further than that. I'm always, when you do see a break of these double tops, the neckline is always the first port of call for potential resistance, and it coincides nicely here with a 38.2. If we break through there, then I'm always eyeing up these fib levels for possible rotation points lower. So looking at this overall, I think, yes, it's whipsawed. Yes, we are range bound. We're hoping for a break through these 73s. That would suggest the Brexit deal has made some significant progress, and the upside could be significant. In the meantime, though, there's no reason why we couldn't see some more weakness, and the double top certainly does support that. Kiwi dollar's playing out really well, just like the Aussie dollar. If anything, it's more progressed because we did see a move towards these previous resistance and support zone. We consolidated, we broke above, we hit the next resistance and support zone previous from previously, which coincided with the 38.2 fib. We came back and tested the most recent one. Lovely little technical setup here. You can often find that with the Antipodeans as well. We rotated off that new support zone. We've gone higher through the previous high, and now we're running to resistance again around the 200-day simple moving average. I'll be really intrigued to see how we trade in this zone, assuming we actually do get into that zone. I think a break through that 50 fib, which takes us through the 200, through the 233, through the 50 fib, that would be a really interesting move for me. Again, your eyes are then drawn to 70 to 70.50, and if we can break through there, then this just starts to look nicely bullish. I'm not sure we're going to have the legs for that, but maybe in the medium term, then that's the case. I think near term, obviously, if we start to see that sell, some weakness in the dollar, which I am anticipating, that could be enough to really drive this higher. Near term, I think we may have to wait a little bit longer for that. So what that could leave us open to is getting into these kind of zones and potentially correcting back, at which point you use the, I would be looking at the fib from the low here to wherever the peak is and looking at potential rotation points higher. But again, a little bit ahead of ourselves. I think at the moment we are up towards the upper end of where we may reach in the near term. Naturally, although if we do break higher through that 70.50 in particular, then this could potentially really take off. But so far, that's played out beautifully. And now we're just entering into a very interesting zone here. The yen pairs, if I'm honest, just don't interest me. The yen is being favoured in terms of risk aversion, but apart from that, we're seeing a lot of choppiness. The dollar yen pair is the nicest at a lot, but I don't feel like the technicals are giving us enormous insight. So for dollar yen in this scenario, for example, we have broken below the rising channel. I've put this on as an indication, but I'm not buying into it too much because we have had a false breakout just here. I think 112 is really interesting here. We've got the 55.89 moving average band coinciding with the Ichimoku cloud. A break below here could be a sign of weakness here, but ultimately we'd then have to see a break of these 111.50s to get confirmation from the lagging line. That could potentially follow. But the problem with this chart is this chart in particular is so driven by risk appetite. And it depends what risk appetite you're looking at. When you're looking at trade war risk appetite, then you do tend to see some support for the dollar. If you're looking at general risk appetite from an overall market sell-off, it tends to favor more the yen. So the technicals, I'm not sure how much we can read into them, but I think if you want to read the technicals, the 112s are interesting. It would suggest the market is bearish on this particular pair. If we see a break below there, and then 111.50 becomes key. I wouldn't be surprised though to see that rotate just higher on the back of that though. This is where it gets messy though. Sterling yen, range bound, choppy, bit wild. Range lows, you're looking at around the kind of 142.50s, although we have had a break before when we had that significant risk averse period earlier on in the summer. The highs around these kind of 150s. If we break a break above there, then that would suggest to me that we are either near or have seen a significant movement on the Brexit side of things. I think the more likelihood is that we are going to continue to see that chop in the interim. And again, we could see maybe some consolidation. So don't be surprised if we don't quite reach the lows here, unless there's a big risk move driving it. Euro yen's even messier, if I'm honest. I really hate this chart. I just don't really, there's nothing I'm really struggling to read anything into this chart, and I don't often say that, but yeah, we kind of have these lows here around the kind of 127s, right? So we have found lows around these levels on a few occasions. So if we do see a break below the 127, then potentially we're looking at this kind of 125 region for where the market could be heading. Is that a really bearish signal? No, not for me. I think we could quite easily chop straight back higher. Equally, we could never break below that 127. We could chop higher through 130. We could move back towards these kind of 132s, and then we could start to run into resistance and chop again. I just think if you're a range trader, then perhaps this is something that interests you. But again, it's like the chart I showed you earlier. It's not a nice range. It's a choppy, inconsistent, and very volatile range. So it's not something that particularly interests me. It's not something that's giving strong signals as far as I'm concerned. So yeah, not particularly one that gets my attention. Interesting that we around these kind of 130s, we have found some resistance here, and we are making higher lows. So in the near term, potentially that's a bullish sign, with a breakout of 130 confirming that, especially if we fail on this current decline to make a new low below 127.50. But really, I think I'm kind of clutching at straws on this one. I just don't think it's that interesting a chart. I think there's plenty more interesting charts out there, as we've covered throughout. So that is everything. I hope you all found that useful. For once, we've almost finished on time and a couple of minutes over. Once again, thank you all for joining us. If you've got any questions that you couldn't think of during the webinar, then please do reach out to me on Twitter. It's Craig_Forex. Check out this recording if you've missed anything later. You'll find it on YouTube, Market Pulse, and also my Twitter page. And finally, one last push for the OANDA Market Insights podcast. That will be released on Friday. We released the last one on the Friday just gone. Without meaning to big it up, it was a really interesting chat on Friday with so much going on. So I highly recommend you check that out for some more in-depth insight into what we've been talking about today. There's also the OANDA Market Beats podcast. That's being driven by Alfonso over in Toronto. So again, check that one out. Let us know your feedback. Everything's welcome. We're just trying to create as much interesting, insightful, educational content for you guys as we can. So any insight, any feedback is always welcome so that we can improve it. But apart from that, I really do wish you all the very best of luck with your trading. I hope you have a fantastic week, and I'll catch you again next Tuesday. Thank you very much.